Hi, I'm Chris Britton, Director of Tax and Estate Planning for IDC Worldsource, and I'm here today to give you a tax update. There was a lot of noise last summer when the Liberals announced that they were going to implement changes to owner-manager private corporations. The industry backlash was significant, and as a result of that, the tax changes that have now been implemented are significantly less onerous than what they had initially proposed. They introduced the tax on split income legislation in December. It was quote-unquote simplified. I still think it's rather complicated. However, income splitting with children through corporations where the children aren't actively involved in the business is probably dead. Also, income splitting with spouses with corporations, if they're not active in the corporation, is going to be significantly more difficult. If you have clients who were using that type of strategy in the past with a private corporation, they should probably go and see their tax advisor to make sure that they were or were not impacted by those changes. More recently, the budget was released on February the 27th. There was a lot of concern as to what the passive income rules were going to be with respect to holding investments inside of private corporations. The proposals that ended up being tabled in the budget didn't nearly have as many teeth as the proposals that were announced in July. So originally the proposals were if you had investment income over $50,000 inside of a private company, it would be taxed at the rates that it's being taxed at now, but they were going to remove the refundable tax system, which would have ended up meaning that you would have a tax rate somewhere near 75% on the investment income earned by your corporation. They also said, however, any investments that were already there would be grandfathered. I'd given a number of presentations about these proposals over the last 6 months, and every time I started to give the presentation, I would say they have not released any legislation. I don't know how they're going to do it because I think it's going to be too complicated. And in fact, that is what happened. They determined that creating rules, getting rid of the refundable tax system on a pool of assets was so complicated that it wasn't practical. Therefore, they are going to start implement a tax that is not nearly as painful as the one they proposed. However, it will grind down your small business deduction. So if you have investment income over $50,000, for every dollar of investment income you have over $50,000, you will lose $5 of small business deduction. Therefore, if you have investment income over $150,000, you will completely lose your small business deduction, which means that your tax rate could go from 14% to 30%. So you will lose that 16% deferral opportunity. You will, however, as you pay out dividends, have a larger eligible dividend pool, so the flow-through of that income, it probably won't cost you significantly more tax. It will cost you some more, but not significantly more. However, if your strategy was to defer tax by leaving money inside of your company, earning a dollar of earning a dollar of investment income over the $50,000 will end up costing you about $1.30 in current tax. So you'll still pay your 50% tax. You'll still pay your 50% tax on the investment income or 52% tax on the investment income, depending on the province that you're in. And your small business rate, if you otherwise earn $500,000, will go from, say, 14% to 30%, which is an extra 16% tax times 5, which is 80. So 80 plus the 50 will cost you $1.30 in tax. The good news in the budget is that they did not implement any new rules with life insurance. They did not touch the capital dividend account. They did not increase personal tax. They did not increase corporate tax. They did not change anything with respect to TFSAs or RESPs or RRSPs. And so it was basically a pretty bland budget from a tax perspective, except for these passive income proposals. So the good news for people in our industry with these tax changes is that the passive income rules are an income-based test. i.e. you need to have either interest income or rental income or capital gains or dividend income in order for those rules to get triggered. So people will be looking for strategies that defer or make income go away on assets as they're growing. So life insurance becomes a very good alternative for a business owner because the increases in the cash value are tax-free, and the business owner can then utilize these cash values in retirement. The options in retirement are three. One is the business owner could simply take cash out of the policy, pay tax at the applicable rate depending on what his cost base is, and then pay himself a taxable dividend. That is the least risky of the three strategies. Least risky from a tax perspective and least risky from an interest rate risk or longevity risk perspective. The second option is to borrow money out of the policy into the corporation and then pay a taxable dividend out to the shareholder. This is the least risky from a tax perspective, however, starts to add a little bit of risk from an interest rate risk and a longevity risk. The third option is the shareholder borrows money and pledges the corporate asset as collateral. This is the most risky from a tax perspective in that Revenue Canada's view is that there is a taxable benefit for the corporation pledging an asset as collateral for a shareholder loan. And their view is that the taxable benefit is calculated in one of two manners. One is if because you got a secured loan instead of an unsecured loan, you were able to negotiate a better interest rate, the reduction in the better interest rate is equal to your taxable benefit. If the interest rate would have been the same, whether you collateralized put the insurance policy up as collateral or not, then the taxable benefit is equal to an arm's length guarantor fee. I've seen in the industry people use 1% to illustrate what the guarantor fee is, but I don't know if that has any industry basis. I think somebody should do research and find out what an arm's length guarantor fee would actually be. And then on death, the loan can be paid out, and whatever's left over from capital dividend account perspective can be distributed out to the estate.